Welcome to the research desk.
Glad to be here.
So I want to start by posing a question that really sits at the very foundation of modern systematic trading. It's something that kind of baffles me.
Okay, let's hear it.
Why does the most important equation in artificial intelligence, I mean the exact mathematical function that drives hundreds of billions of dollars at companies like Amazon and Netflix, why does it remain virtually invisible to the vast majority of quantitative investors?
That is the big question, isn't it?
Right? And conversely, when we look at the structural fabric of financial markets, why does the primary tool that the entire financial industry relies on, Pearson correlation, systematically fail to detect 40 to 60% of the actual relationships governing asset prices?
Well, I think you're setting up a pretty massive structural blind spot there.
Exactly. It is a massive blind spot. And today, we are really analyzing a fundamental transition in how we measure reality itself. We're moving away from the basic concept of Shannon entropy.
Which basically just tells us that uncertainty exists, right?
Exactly. It's just a baseline. And we are moving toward the fundamental trinity of information theory as it was codified by Cover and Thomas.
Right, the 2006 text.
Yeah, that trinity consisting of Kullback-Leibler divergence, cross-entropy, and mutual information. And look, for our audience, these are not just theoretical constructs. They are the precise mathematical tools that define exactly how wrong a predictive model is.
So just to establish where we both stand on this, because I know we have very different views on the practical application here.
Right. We should lay that out. So my position, the one I'll be championing today, is that mastering these three information theoretic tools is the ultimate technological upgrade. It's the defining line separating dominant apex quantitative firms like Renaissance Technologies from literally everyone else.
Because they map the nonlinear realities.
Exactly. Realities that traditional linear models structurally and inevitably ignore.
Okay, well, as the counterweight here, my position is that your framing presents a very beautiful theoretical architecture. But theoretical elegance rarely survives what mathematicians call the curse of dimensionality.
Ah, the curse of dimensionality. I knew you'd bring that up.
I have to. I mean, the sheer practical difficulty of estimating these really sophisticated metrics in the real world, specifically in noisy, non-stationary financial data, it means that traditional linear models remain, well, surprisingly competitive.
And incredibly resilient.
Resilient, maybe, but at what cost?
Well, we are not dealing with the clean, static data sets you find in a computer science laboratory. Financial data is messy. So I'll be arguing that the computational and statistical cost of identifying these nonlinear relationships often vastly exceeds the alpha they actually provide in a live trading environment.
Okay, I hear that. But to understand why this is such an existential issue for quantitative finance, we really have to recognize that the stakes are no longer theoretical. We are talking about hundreds of billions of dollars left on the table.
Hundreds of billions? Yes, literally. Let's look closely at that landmark 2020 paper by Gu, Kelly, and Shu, the one published in the Review of Financial Studies.
Right, the empirical comparison paper.
Exactly. They conducted this exhaustive empirical analysis comparing machine learning models with traditional linear models. And what they demonstrated was that machine learning models, specifically those trained by minimizing cross-entropy loss, they capture 50 to 60% of the monthly variation in asset returns.
Out of sample.
Yes. Now, compare that to the linear factor models, which, still form the backbone of traditional asset management today. Those linear models, they capture only 30 to 40% of the variation.
So you're looking at a 20 percentage point gap.
A 20 percentage point gap. That is immense. I mean, that's not a statistical rounding error. When you translate that to market capitalization and deployment, it represents roughly $200 billion in aggregate alpha across the quantitative industry.
Okay, but
Just to finish the thought, every recommendation engine dictating what you watch on Netflix or buy on Amazon, and every advanced AI trading model deployed by top-tier funds, they all rely on the exact same underlying calculus. They are relentlessly minimizing the KL divergence between their internal model of the world and the true distribution of reality.
Okay, but comparing a quantitative trading firm to Amazon or Netflix, that glosses over the fundamental nature of financial data.
How so?
It's entirely different from consumer behavior. When we talk about minimizing the Kullback-Leibler divergence or just KL divergence between a model and reality, we have to acknowledge a massive, massive assumption.
Which is?
To compute that divergence properly, you need to actually know the true distribution of reality. You need the complete map of the territory.
Sure, P. The true distribution.
Right, P. Netflix has a near-perfect map of consumer reality because human preferences for, action movies or romantic comedies, they are relatively stable. And the data is a closed loop.
Fair.
But in financial markets, reality is never handed to you in a clean, closed-form equation. It's estimated from incredibly noisy data that is subject to extreme, totally unpredictable shifts.
I mean, it shifts, yes, but...
Let me just bring in the perspective advanced by AQR Capital Management. Researchers like Cliff Asness, they look at these machine learning models and argue, quite compellingly I might add, that while the nonlinear premium in asset pricing is real, it's actually quite small in practice.
I wouldn't call 20 percentage points small.
But it gets eaten. That's the point. Whatever small premium you manage to extract gets entirely eaten by transaction costs, portfolio turnover, estimation error, and out-of-sample deterioration.
So you just stick with the linear models?
The reason simple linear factor models, which often operate with just basic Gaussian or bell curve assumptions, the reason they remain the industry standard is because they are robust. They actually survive the exact estimation errors that completely destroy complex nonlinear models when you take them out of the backtest.
I understand the argument for robustness. I really do. But we need to examine what you are sacrificing for that robustness.
I'd say we're sacrificing illusion for survival.
No, the sacrifice is catastrophic blindness to real market mechanics.
Catastrophic blindness? That's a bit dramatic.
It's accurate. To understand the magnitude of what the linear approach misses, we really must contrast standard Pearson correlation with mutual information.
Okay, let's get into the math then.
Let's use a medical analogy. Imagine a physician examining a patient with a heart condition. Relying on Pearson correlation is the equivalent of placing your naked ear against a patient's chest.
So functional but basic?
Right, you will hear the heartbeat, certainly. You'll get the primary linear rhythm. But mutual information, that is the stethoscope. It's a precision instrument that picks up the subtle murmurs, the specific valve clicks, the hidden arrhythmias that the naked ear just entirely misses.
Okay, I like the analogy. But give me a market example.
Let's apply it directly to the relationship between the VIX, the market's volatility index, and the S&P 500.
Classic inverse relationship.
Exactly. If you measure their relationship using Pearson correlation, you get a value of approximately negative 0.75.
Right, so market goes down, volatility goes up. Very standard.
That simply tells you they move inversely. But if you measure their mutual information, it registers at 1.2 bits.
Okay, wait. Before we move past that, we really need to clarify what that measurement actually means in practical terms. Because moving from a percentage-based correlation to measuring in bits, that fundamentally changes how we are interpreting the data.
Absolutely. So, in information theory, a bit represents the reduction of uncertainty by half.
Right, a binary choice.
Yes. If you have one bit of mutual information between two variables, it means knowing the state of one variable cuts your uncertainty about the other variable exactly in half.
Okay.
So when the mutual information between the VIX and the S&P 500 registers at 1.2 bits, it tells us there is a profound structural relationship there. But the crucial difference between the simple correlation metric and the mutual information metric is that mutual information captures non-linear crash amplification.
Crash amplification, meaning the tails.
Exactly, the tails. Think about how markets actually behave during a crisis. A gentle 2% drop in equities might cause a minor rise in the VIX. But a sudden 5% drop in equities? It does not yield a linear, proportional 15% rise in the VIX.
No, it explodes.
It yields a violent, convex 40% explosion. Pearson correlation is structurally blind to that convexity. It tries to draw a single straight line through a relationship that is fundamentally curved.
Because correlation assumes normal distributions.
Yes. And Fiedor's 2014 research in the journal Physical Review E demonstrated this conclusively. By constructing networks based on mutual information rather than simple correlation, Fiedor mapped global markets differently.
How so?
Instead of just looking for straight lines, his networks captured circles, parabolas, complex threshold dependencies. And by doing so, He exposed 40 to 60% more actual financial structure than traditional correlation matrices.
40 to 60% more?
Yes. And Huang and Co. similarly found that 23% of statistically significant predictive macroeconomic relationships were completely invisible to correlation. They literally looked like random noise until viewed through the lens of mutual information.
Okay, that sounds incredibly powerful in a published paper. But deploying mutual information in live trading systems introduces an estimation nightmare, one that, frankly, fundamentally undermines that theoretical superiority you're talking about.
I wouldn't call it a nightmare. It's a solvable engineering problem.
No, we must critically examine the standard errors inherent in actually generating these measurements. When quantitative researchers attempt to measure mutual information in multidimensional space, they typically use industry-standard k-nearest neighbor estimators.
Sure, the Kraskov estimators, right?
Exactly. The most famous are the Kraskov estimators developed around 2004. The concept involves looking at the data points closest to your target in a multidimensional space to estimate the local density of the market.
Which works beautifully.
In theory. But in finance, that space is incredibly sparse, and it's volatile. Consequently, when applying Kraskov estimators to real financial data, the standard error of your measurement is routinely 0.1 to 0.3 bits.
It can be high, yes, but
Let me finish this point, because this introduces a fatal mathematical catch for the systematic trader.
okay.
If the true underlying mutual information between two financial assets is 0.15 bits, but your standard error, your margin of error, is 0.2 bits, you are not measuring structure anymore. You are measuring pure noise.
Well, the superior structure detection you're describing requires a computational and statistical burden that functionally destroys the theoretical alpha. When you build a portfolio using these metrics, you're asking practitioners to optimize hundreds of millions of dollars based on phantom signals. Signals generated by statistical variance rather than underlying market reality.
Look, the noise inherent in estimating mutual information is significant. I'm not denying that. But it is a cost absolutely worth paying.
Worth paying to trade on ghosts?
Because of what I call the threshold effect. Let's ground this in a real-world corporate credit scenario.
All right, let's hear it. Consider a company's credit spread. The yield penalty they pay on their debt and its relationship to their quarterly revenue growth. For years, that relationship might exhibit a perfect zero correlation.
Because they're healthy.
Right. Revenue goes up a bit, down a bit, and the credit spread barely moves at all. A standard correlation-based risk model averages that relationship out, declares the variables mathematically independent, and tells the risk manager, hey, there is nothing to worry about.
Until there is.
Exactly. Corporate finance is governed by thresholds. If that revenue drops below a specific legally binding debt covenant trigger, the company is suddenly at risk of technical default. At that exact threshold, the relationship instantaneously becomes intensely negative. Default risk surges, and the credit spread explodes outward.
Which is a non-linear event.
A massive nonlinear event. A linear correlation model misses this entirely because it demands a consistent, straight-line relationship across the entire distribution of data. It literally expects the relationship to be the same on a sunny Tuesday as it is during a liquidity crisis.
And mutual information doesn't.
Mutual information does not care about straight lines. It captures the dependence regardless of the threshold trigger. Missing a catastrophic tail event, like a corporate default, because your risk department demanded statistical cleanness and low standard errors, that is a far greater failure than tolerating the estimation noise of a k-nearest neighbor estimator.
So you prefer a noisy warning over a silent crash.
Exactly. The blind spots created by correlation are not just academic curiosities. They are existential threats to a portfolio.
Okay, but let us follow that thread from just recognizing relationships to actually building the models that trade them. Because if mutual information is how we detect the hidden structures, cross-entropy is the framework we use to train the models to exploit them.
Yes, the optimization function.
Right, cross-entropy is constantly heralded in the machine learning literature as the ultimate universal translator of alpha. But we have to evaluate whether this translator functions effectively when the underlying language of the market is constantly changing.
It does. Cross-entropy is the perfect framework precisely because it forces the model to account for the full spectrum of reality.
if reality stays still?
Well, let's break down the mathematics conceptually first, so we're on the same page. I mean, if you break it down, cross-entropy is effectively the sum of two distinct components.
Shannon entropy and KL divergence?
Right. The first component is the irreducible uncertainty of reality itself, Shannon entropy. The second component is the Kullback-Leibler divergence penalty, which measures how far your specific model deviates from that reality.
Okay.
Think of it like a restaurant critic tasked with reviewing dining experiences.
A restaurant critic?
Stay with me. You cannot reduce the inherent variety, chaos, and unpredictability of the restaurants themselves. Some will have fires in the kitchen, some will change their menus, some will have brilliant new chefs.
That chaos is the Shannon entropy.
Exactly, the irreducible entropy of reality. What the critic can do, however, is minimize the effort it takes to explain those experiences by developing a better, more precise vocabulary.
I see where you're going.
If the critic only knows the words good and bad, the encoding cost to accurately describe a complex, multi-course Michelin star meal is enormous. You lose massive amounts of information. But if the critic expands their vocabulary to include nuance, the cost of translating the experience drops.
And that cost is the KL divergence.
Yes. In machine learning, when a developer in PyTorch runs a loss.backward command to optimize a neural network, they are quite literally pushing that KL divergence penalty lower. They are forcing the model to learn a better vocabulary to describe reality.
Which generates the alpha.
Demiguel, Martin Nutrera, and Nogales demonstrated this power mathematically in their 2020 research. They found that a mere 10% reduction in cross-entropy loss, just a 10% improvement in the model's vocabulary, generates 50 to 80 basis points of pure annual alpha.
50 to 80 BPS.
That is massive in the quantitative space. This is why Amazon can drive $200 billion annually, roughly 35% of its total revenue, by minimizing this exact mathematical equation in its recommendation engines. Cross-entropy provides the precise energy cost of your model's vocabulary mismatch with reality.
But here is the critical flaw in the restaurant critic analogy and what I call the stationary trap of cross-entropy optimization.
The stationary trap?
Yes. It assumes that reality, the true distribution of the market, stands still long enough for your model to learn its vocabulary.
It learns adaptively?
Not fast enough. Amazon and Netflix operate in environments where human preferences evolve at a glacial pace. If you like science fiction movies in January, you will probably still like them in March. The true underlying distribution of consumer behavior is stationary.
Usually, yes.
Financial markets, by contrast, suffer massive, abrupt structural breaks. The behavior of the market on a given day is highly dependent on shifting macroeconomic regimes. Look at recent history. We had the unprecedented liquidity crisis and crash in March 2020.
Which broke almost every model.
Exactly. And that was immediately followed by the bizarre retail-driven meme stock phenomenon of 2021, which broke all historical pricing models. That was then followed by the aggressive Federal Reserve tightening cycle of 2022, which fundamentally altered the cost of capital.
All massive regime shifts.
These are paradigm shifts where the true underlying distribution of reality violently reconfigured itself. Gao, Ku, and Lin proved the danger of this in their 2018 research. They demonstrated that model diagnostics based on Kullback-Leibler divergence lose 40 to 50% of their discriminative power precisely during these regime transitions.
That's a significant drop?
It's a fatal drop. Think about what that means in practice. A sophisticated model that was perfectly calibrated with a minimized cross-entropy loss in January 2020 was fatally miscalibrated by March 2020.
Because P moved.
Yes. This failure did not occur because the model's parameters decayed or broke. It failed because the true distribution of reality, P, abruptly relocated. Cross-entropy looks flawless in sample. When you are looking at historical data, it allows the model to over-optimize to historical nonlinearities.
But out of sample.
It completely breaks down when reality shifts out of sample, leaving the systematic trader heavily exposed to a market that no longer exists. You're trying to use a vocabulary for a restaurant that just burned to the ground.
I love that you brought that up, actually, because that breakdown you are describing, it reveals the most profound mathematical truth within this entire information theoretic framework.
How does an out-of-sample breakdown reveal a profound truth?
It brings us to the core property of Kullback-Leibler divergence, its fundamental asymmetry.
Ah, the asymmetry.
Yes, KL divergence fails the property of symmetry. In pure mathematics, the distance from point A to point B is exactly the same as the distance from point B to point A. But in information theory, the divergence of reality from your model is not equal to the divergence of your model from reality.
Right. DKL of P parallel Q is not equal to DKL of Q parallel P.
Exactly. To grasp why this matters, consider a GPS navigation system. If your map, which represents your internal model, says a road is open, but in reality that road is closed by a concrete barrier, you drive at full speed into a wall. The penalty is infinite. It is a catastrophic failure.
You crash.
You crash. Now reverse the scenario. If the map says an open road is closed, you simply take a detour. You lose 5 minutes. The penalty is incredibly mild. It is just a missed opportunity.
Okay, that's a brilliant analogy.
KL divergence structurally encodes this reality. It is not just measuring distance, it is measuring the directional cost of being wrong. It penalizes you astronomically when your model is highly confident about a reality that simply does not exist.
And honestly, we are in complete agreement on this principle.
Really? The dissenter agrees?
This asymmetry is precisely what triggers systemic global collapse.
2008.
Exactly. We only need to look at the anatomy of the 2008 financial crisis to see this in action. The quantitative models powering the mortgage-backed securities market, most notably David Lee's Gaussian Copula model, they optimize what we would call model-centric divergence.
Right, optimizing Q to P instead of P to Q.
The model essentially asks the question, given my elegant, symmetric Gaussian parameters, how surprising is the data I am seeing in reality?
And it wasn't surprised at all. Until it blew up.
Under that model-centric framework, because it assumed a bell curve distribution of risk, it assigned a near-zero probability to correlated system-wide mortgage defaults. It assumed that if one housing market in Florida failed, it would not simultaneously trigger failures in Nevada and California.
Which is absurd in hindsight.
Had the quantitative risk managers of that era utilized reality-centric divergence, the asymmetric tool we are discussing, the metric would have screamed a 2 to 3 bit warning.
Because reality-centric divergence penalizes where reality actually has mass.
Yes, it penalizes the model everywhere reality actually has mass, including the extreme, catastrophic, fat tails of the distributions. The model-centric approach allowed risk managers at Lehman Brothers and Bear Stearns to confidently drive their portfolios into a concrete barrier because their symmetric map told them the road was clear.
Exactly, and the daily cost of making those symmetrical Gaussian assumptions is mathematically staggering when you actually calculate it. Financial markets are fundamentally characterized by fat tails. This is a reality that has been meticulously documented by Benoit Mandelbrot since 1963.
Right, the cotton prices study.
Yeah. To visualize this, we look at kurtosis, which measures the shape of a distribution's tails. A standard normal distribution, the bell curve, has a kurtosis of 3. It implies that extreme events are incredibly rare.
3 standard deviations is supposed to be the limit of normalcy.
But true market returns often exhibit a kurtosis of 8. The center of the distribution is sharper, the shoulders are hollowed out, and the tails, the extremes where fortunes are made and lost, are remarkably thick.
So when you force a kurtosis of 3 onto a market with a kurtosis of 8,
when a risk manager insists on using a standard Gaussian model on a fat-tailed market reality, they incur a measurable information penalty. The model error translates to roughly 0.3 to 0.5 bits of lost information per single trading day.
and when you compound that daily 0.3 to 0.5 bit error over a standard 252-day trading year, the magnitude of the blindness becomes undeniable.
It's terrifying.
You accumulate roughly 75 to 125 bits of wasted encoding capacity. Your model is essentially shedding critical data about extreme risk every single day.
Every single day.
This compounding mathematical asymmetry perfectly explains historical disasters prior to 2008 as well. It explains why industry standard systems like JP Morgan's risk metrics systematically underestimated tail losses by 30 to 50%.
Which led to LTCM.
Exactly.
That exact symmetric underestimation is what ultimately led to the catastrophic blowup of long-term capital management in 1998. Evaluating modern, complex financial models with symmetric statistical tools like R-squared or root mean square error RMS, it's the equivalent of deploying a 1900s toolkit in a 2020s market.
A complete mismatch.
The deepest, most profound value of Kullback and Leibler's original 1951 equation is that it serves as a flawless mirror for the existential asymmetric risk generated by financial reality. It mathematically understands that missing a tail event is fatal.
I think this beautifully maps the complete topography of the quantitative problem we face today.
It really does.
We can view Shannon entropy as the raw terrain itself, representing the irreducible chaos and fundamental uncertainty of the global market.
The landscape.
Right. Kullback-Leibler divergence is the compass, measuring exactly how far and in what direction your internal map deviates from that harsh terrain. Cross-entropy serves as the total energy cost of navigating the world using an imperfect map, and mutual information operates as the telescope, allowing us to see the hidden topological structures, the nonlinear dependencies, and the threshold triggers that the naked eye of linear correlation will simply never perceive.
That is a very poetic way to describe a bunch of stochastic calculus.
Well, you know me, but the industry continues to look at this landscape from different vantage points. I maintain that there is an absolute imperative to utilize these advanced information theoretic tools to harvest the nonlinear premium. Yes, it is difficult. Yes, estimation noise exists.
Lots of it.
But overcoming that noise is simply an engineering problem. It requires building the technological infrastructure, the superior estimators, and the computational power to map reality accurately.
Well, while the topography is accurately described, the underlying constraint of that terrain remains the curse of dimensionality.
We're back to the curse.
Always back to the curse. That curse tightly bounds the real-world utility of these metrics when applied to noisy, finite, and constantly shifting financial datasets. The theoretical alpha embedded in these nonlinear models is perpetually fighting a brutal war of attrition.
A war of attrition?
Yes. It is fighting against estimation standard errors that create phantom signals, transaction costs that erode margins, and sudden non-stationary regime shifts that instantly render heavily optimized models obsolete. The elegance of the math does not neutralize the friction of the market.
Regardless of the friction, the mathematical language of model error is ultimately non-negotiable. Whether you are operating as a senior researcher with vast compute power at Renaissance Technologies, or managing a smaller, independent systematic portfolio, reality always gets the last word.
That is undeniably true. Reality always wins.
You are either deliberately using the Kullback-Leibler equation and cross-entropy to actively extract the hidden nonlinear signal, or you are paying the severe compounding information penalty without ever seeing the itemized bill.
This is the research desk officially signing off.